Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Ray Sturm, CEO, co-founder, AlphaFlow, with me on the show today. Ray, welcome to the show.
Thanks for having me, Michael.
All right, tell us about you and AlphaFlow, and then I want to get right into why are hedge fund groups turning to fintech and the alternatives for investments.
Sounds good. AlphaFlow is an asset manager. We're focused on real estate loans. And what we do is we pair qualified investors, which could be high net worth individuals or institutional investors like university endowments or hedge funds, like we're going to talk about, with high yield loans. And we do that by partnering with local lenders around the country. Think non-banks, hard money type lenders. We're buying loans from them and we're packaging them up for institutional investors.
What is significant that AlphaFlow was able to secure investors like Point72 and Social Capital?
Yeah, I think what's gotten interesting and starting to pull more people into this space is you've got an interesting asset class, but the reason people really didn't attack it before is, one, you couldn't hit it at volume. And if you're one of these large investors, you need to be able to put 9 figures to work in these asset classes, or you can't really dive in that part. And the second part, naturally, is if you get access, can I figure out which investments are good, which are bad? There wasn't really a lot of data out there. So what we did is we started to pull that information together, and really we took an opaque market and we started to make it a lot clearer for these guys to understand where the risks were. And that's where we came in.
Okay. What can we expect from the hedge fund investors turning to alternative investments? Because I see a lot of it here, and that's a huge shift going in this direction. So I'm glad you're on that track, but open that up for me.
Yeah, I think these guys are in the business of always looking for unique opportunities. And one of the challenges they had around a lot of these sectors was it was tough. You saw one-off opportunities. It was really tough to put a lot of work in a strategic way, put a lot of money to work. And I think a lot of fintech companies, AlphaFlow is just one of many, are making that possible. What we're starting to do is take a lot of these little players, and by using tech, we can pull a lot of those guys together. And so now these guys can start thinking about putting 50, 100, $1 billion, 100 million, $1 billion to work in these asset classes. The other thing they need, though, is they need quantitative backing. And so if they're looking at a new asset class and they can understand the risk, the Sharpe ratios, et cetera, of what they've already been working in, and you bring them something opaque and it looks interesting, that's not good enough. And that's what's happened a lot of the last few years. What's starting to finally change in this space is you've got actual capital markets thinking. You've got actual financial thinking in these fintech companies where they're going beyond just being marketing machines, using VC dollars to advertise on Facebook, and saying, let's actually invest in underwriting. Let's actually invest in understanding, how does this perform through a cycle? Now, once you can approach these hedge funds, and these are some of the largest funds in the world we're speaking to these days, once you approach them with that sort of data and that sort of approach, I think that's where they can really get engaged. That's starting to happen more, and so you're getting a lot more of their interest in the space these days.
Give our audience an idea of the kind of companies you're working with in this sector, and some of the, give us a unicorn, a success story.
Yeah, when you start thinking about fintech outside of AlphaFlow, obviously I'm biased right there, but you start thinking about real successful companies that have tied these together. You've got companies that are just getting going, like Drip Capital. They're doing cross-border finance. That's really interesting. A lot of people look at Lending Club right now as really just saying that, oh, it didn't quite make it. I think it's in the early days. That's a multi-billion-dollar company that for the first time people would take credit card debt, 18%, something like that, and bring it down to 6, 7%. Those are the sort of things that really actually drive industry change. Might happen too slowly to realize that there's a big revolution, but 10 years ago, that wasn't possible. So it's gotten interesting.
It is. Tell me about I want to see around the corner here with you. You've obviously chosen this lane because you see something down the road that's really going to pay off big. Walk us through that process of where we're going to end up.
Yeah, I think what you're starting to see is fintech is going back into the mainstream, where one of the issues that a lot of fintech companies that didn't make it hit was really once you run into the capital markets. To really scale, you've got to jump into the capital markets. And that means credit lines through banks, that means securitizations, and that means ultimately moving into what people in the industry call real money, which is not managed money, but think pensions, think people investing their own money, university endowments. To deal with those, you need to hit a certain amount of scale. What we're seeing here at AlphaFlow is that the path we're going down, this path of actually producing data around risk and such, that's what gets us through the agencies to actually get rated on these securitizations we're going to look to put together. As you start to put those together, that's when you can start talking to some of the world's largest money managers. And you get beyond just hedge funds that have honestly a very high cost of capital. They're helping us grow. They're interested at this point, but I can't build a business selling to hedge funds. I need to go beyond that. That's what's really coming.
All right. The appetite for these endowments, these pension funds, these various types of institutional investment companies, is there a particular appetite? I mean, some may not want to be in the cryptocurrency world yet. Some do.
Sure.
Some don't want cannabis. Some do. I want to hear where you're seeing the trends in what these companies or these entities are actually feeling safe enough to start to step into.
Yeah, you make a good point. You've got a handful of them that really go out on the ledge there, but that's the exception. Right. What we're starting to see is for the larger ones that what they need to see is a track record. Historically, they needed 3 to 5 years. That's coming down a little bit now where they're starting to see they're missing opportunities. In our space, real estate bridge loans, these are typically fix and flip loans. So what they like about our space and what gets them excited is it's a really short duration. Anyone looking at the market these days sees a lot of uncertainty. There's a lot of volatility out there. We don't know what the world's going to look like a year from now. My average loan pays off in about 8 months these days. So if you've got 8 to 10% returns, then I can decide in 8 months if I want to keep going and roll that again, or if I'm going to get my money back and go do something else. That's a pretty good value proposition. So as long as we can prove that track record enough, these guys are pretty eager to get involved these days.
Are they trying to keep the money here at home, or do they have an appetite for global presence?
I think they're looking globally now. They're getting creative. Fixed income domestically has just gotten so compressed. It's hard to get real yields. And if you're investing like one of these institutions, what they're ultimately doing in the short run is liability matching. They've got to pay the professors. They got to pay to take care of the university. So they're using fixed income in a lot of ways to really maintain that. And they use equity to actually grow the endowment. So with fixed income, as low as it is in the US these days, it's hard to even liability match. So they need to get a little bit creative. They start looking downstream to companies like AlphaFlow that are a little newer than they might have looked at 5, 10 years ago. And they start looking globally for more interesting opportunities that might actually not increase their risk, but actually get them a little bit more yield.
How do you find these deals? I mean, how do they come to you so that you can say, this is going to work, let's put it through our process?
Yeah, so what we start to look at for the actual loan opportunities is we're scooping up lender partnerships. And what we're starting to see is a lot of these local guys, no one's got their data, no one's got their track record. And we're starting to pull that together to understand what's risky and what's actually not that risky. What looks at, where can we produce a track record that really doesn't have many defaults at all? You start to produce that, the endowments come find you. There's an old saying, right? The cliche saying, money follows money. Well, you do a couple of these deals, they all have friends that they used to work with, and all of a sudden a handful of endowments are calling you and seeing if you've got room for them as well.
Good. It sounds like you're pioneering a whole new paradigm for where these people can actually go to put the money, because if they don't put it someplace, it gets expensive for them.
Absolutely. Yeah, we're trying to do that. We're trying to ultimately not throw everything off, but say, can we tie a new asset class into capital markets that exist, into a system that's working great? Can we bring new opportunities into that? I think that's working today.
I do too. All right, and I think it's going to work in the future for you. Is there anything you wanted to bring out before we close out on today's interview?
Yeah, I think a lot of people end up looking at our space in fintech and such. I think one of the things for people looking into this space is to start measuring how much of the soul of these companies you're working with is in underwriting and credit, and how much of it is just pure marketing. When you're thinking about which opportunities are interesting versus which just look real shiny, look through that lens.
Got it. All right, thanks for being a guest on the show today, Ray. It's been a real pleasure.
Thanks for having me.
My pleasure. All right, you've been watching CEO Money with Michael Yorba. Don't forget, like us on Facebook, follow us on Twitter, and sign up for our YouTube channel. And if you want to become a part of our newsletter with great companies just like this, go to our homepage, WFN1.com, and sign up. We'll be talking to you soon.